saw in the objective that the entire objective of this standard is of obtaining limited assurance. So we'll start our entire activity or our entire procedures from that perspective that we are required to give a limited assurance on this engagement. Irrespective of whatever assurance level do we give on an engagement, materiality is something that is the first thing that comes out to our mind. So materiality is to be computed, unlike like any other standards, like any other auditing standards or review standards, as we are required to calculate materiality at the initiation of the engagement. Similar is the requirement of this SRE also, that we need to compute a materiality. And this is where the professional judgment of the practitioner comes into play. Materiality computation is not just a mathematical exercise or a mathematical computation to derive at a number. It is something in which the practitioner uses its professional judgment, like what is the business of the entity, what has been our past experience with this entity, what is the industry current scenario, whether the industry is into pressure or not. So there are multiple factors which are to be considered before computing materiality, and in fact before computing materiality, multiple factors should be considered, like which benchmark is to be taken for computation of materiality, whether the materiality should be computed on revenue, whether on profit, whether on total assets, total equity. It depends on the understanding and the professional judgment of the practitioner that determining that how the materiality is to be determined. And since all the nature, timing, extent of the procedures defined in this standard or in any other standard for that matter is dependent on the materiality, so it's very necessary that the materiality computed at the first place is accurate and is appropriate. So a materiality is to be determined for the whole financial statements. It is to be designed in such a manner, it is to be computed in such a manner that it will be used for designing the procedures and evaluating the results obtained. And during the course of the engagement, if it is felt that the materiality is to be revised, then on the basis of the information available and the revised benchmark balances and thresholds that we have accepted or we have used during materiality computation is to be revised and a new materiality is to be computed. And after the basis of new materiality computation, it is again to be evaluated whether the procedures that we have carried out earlier pre-revision still holds good, or do we need to extend our audit procedures, or do we need to modify our procedures. Not audit procedures for this SRE2400 perspective, it's the procedures. So once we have computed the materiality, then comes understanding of the entity and its environment. It's very important for any assignment to be carried out for any entity that we understand what exactly is the entity into. Like what is the business of the entity, which industry is into the entity, how is the entity doing good in terms of the business as compared to its peer, what are the accounting systems the entity is being using for its financial statements recording, what are the other factors like management's characteristics, integrity, what is the organization structure. All those things are required to be understood by the practitioner in terms of internal environment and an external environment. So there are some factors which are relevant from an engagement perspective, which are internal to the company. Like I said, what are the accounting systems the company is using, how the performance of the entity as compared to the previous periods as compared to the peers, what are the organization structure, whether there is a huge attrition in the company, how is the overall environment of the company in terms of that. So all these internal environment factors are to be evaluated, and similar to that, the external environment factors are also required to be evaluated. How is the industry doing, what is the economic scenario, what are the legislation changes coming which is going to impact that industry or that entity as a whole. So all these factors are required to be understood, and areas which are likely to be misstated or where there is a prone of misstatement are to be identified during all those understanding obtained by the practitioner and the team, and then accordingly the procedures are to be designed to address all those areas that we have identified are risk prone or prone to material misstatements, or on the basis of the understanding obtained for all those internal and external environment are to be kept in mind, and then accordingly the nature, timing and extent of the procedures required for the performance of the engagement is to be decided. We saw in the objective slide itself that the objective of this SRE is that it is required, but the SRE requires the practitioner to obtain a limited assurance by two things. First, doing an inquiry procedure, and second, by doing an analytical procedure. So analytical procedures in the very basic sense we understand, or for an example, we can take a variance analysis, like comparing the numbers, say suppose of sales number, we are comparing the sales of financial year XYZ, financial year 2019 to financial year 2018. So this is the very basic analytical procedure that we do in our day-to-day activities or day-to-day assignments. But analytical procedures have a very big ambit. Financial information and non-financial information both can be used for the purposes of analytical procedures. So it's the responsibility of the practitioner that using the professional skepticism and its professional judgment, it design appropriate analytical procedures so that it can form sufficient or obtain sufficient appropriate audit evidence or sufficient appropriate evidence to conclude that the financial statements are as a whole free from material misstatements, or nothing has come to their attention which causes them to believe that the financial statements are not prepared in all material respects as per the applicable financial reporting framework. So the financial information as well as non-financial information should be adequately used by the practitioner in terms of designing and performing the analytical procedures. And the analytical procedure should also be performed not only for the financial numbers but also for the disclosures. So we see that performing analytical procedure consists of to address all material items in historical financial statements including disclosures, and its focus should be on areas where misstatements are likely to arise. So if we do an analytical procedure from these perspectives, what will happen is that we will end up with all the sufficient evidences that we require to form a conclusion. And the most important part, while designing analytical procedure and performing analytical procedure, the entity's accounting systems and the accounting records should also be considered. For example, if there are two entities, entity A and entity B, entity A has a very sound accounting system with appropriate controls and segregation of duties, whereas accounting B has not that sound accounting system and there are no appropriate segregation of duties, there is no concept of park and post of entries, then in that case the analytical procedures that are to be done at an entity B level who do not have very sound accounting systems or policies, the analytical procedure done for entity B would be much higher or would be of much high extent of reliance would be placed on the system. High extent of reliance cannot be placed on the systems, and so the detailed manner in which the analytical procedure would be done for entity B would be more as compared to entity A. So it's very important to design and perform the analytical procedures considering all those factors. Now comes the inquiry. Inquiry is the most common thing that we do. We go talk to people, talk to management, talk to their team, like what is to be done, how is the business going on, how is the business running, what is the industry doing, have you launched anything new, what are your future plans. So there are multiple inquiries that we do in our day-to-day time or while carrying out our engagements. But when we say we need to obtain a limited assurance by performing either an inquiry or analytical procedure or both, then we should also be doing some specific inquiries. So just to point out a few, I have mentioned something which is to be exactly done in terms of doing an inquiry. How management makes an accounting estimate under the financial reporting framework. Accounting estimate is something which is very important from a financial statement presentation point of view. Just take an example of useful life of property, plant and equipment. This is the most basic accounting estimate every organization has. Even if that goes wrong, the financial statement may depict a wrong picture. So how is accounting estimate designed or how an accounting estimate is decided in an entity is very important from a financial statement perspective. Whether it's any junior management team who decides the accounting estimates and gives the hit to the financial statements, or whether the accounting estimates goes through an approval levels and is discussed at appropriate levels before it is being considered as final. So this is something which is very important from an inquiry perspective, that we understand how is the management's control in terms of designing the accounting estimates or in terms of deciding the accounting estimates. Second, related party transactions. Related parties are always a critical area in the financial statements. Related party transactions, related party balances always poses a risk to the financial statement to some extent. in terms of arm's length price. If the transactions are not done in the arm's length price, an entity may suffer a hit, a loss, or anything else, and the benefit may pass on to the other entity. There's the situation which always happens in the arm's length price. Another situation which comes into the related parties, that there are a lot of amounts outstanding to related parties which is recoverable in the entity's book, but the amounts are not being recovered. So it keeps on accumulating year on year. So all these things in terms of related party identification, related party transactions, etc., a proper inquiry in terms of all those factors is required with the management. In a complex group structure, it even would become difficult to identify a related party transaction. So how does a management identify a related party transaction in their entire business ambit is also something which becomes important in those structures. So it's necessary that we go and inquire with the management, with appropriate level of management having that amount of knowledge in terms who can answer our question at least. It does not make a point we just go and ask somebody who does not have a knowledge of that particular area and we say that the inquiry has been performed. The inquiry is apt only when it is asked, the right questions are asked to the right person. Some other points of inquiries can be significant, unusual, complex transactions or events that may affect the historical financial statements, like a mergers, a demerger. There is a complex accounting issue. Maybe it may be related to any issue of compounded instruments or CCPS kind of instruments. So all those financial instruments, so all those accounting transactions are also to be looked after and also to be inquired with the management. Existence of any actual, suspected or alleged frauds or non-compliance with the laws and regulations. Whether the company or whether the entity is aware of any such act that a fraud has been committed by the company, on the company, or by the employees of the company or anybody else, any alleged notification, any alleged news of the fraud or non-compliance with laws and regulations. This is to be categorically asked, because these are something which generally does not come out from the financial statements perspective, and we need to apply our professional skepticism and judgment to identify whether any fraud has been done or it's undergoing in an entity. How the subsequent events are addressed, the going concern assumption, since it's the basic principal assumption we take while preparation of financial statements. So the going concern assumption, how management has estimated or how management has studied that their going concern assumption is appropriate and concluded their going concern assumption is appropriate. So all those evaluations should also form part of our inquiry. So an inquiry, there cannot be a list of 15, 20, 25 questions in terms of what needs to be asked to the management. It all depends on what are the understanding level we do have of the entity, how is the entity performing, the internal and the external environment of the entity, and the professional judgment, of course, of the practitioners, when we can have a good and a sound inquiry so that it will help us as a practitioner to obtain sufficient appropriate evidence to form a conclusion. So these are the procedures that are required to be done from this standard perspective. Some other procedures, these are two primary procedures, inquiry and analytical procedures. Some other procedures, these are like reconciling the financial statement to the accounting records that we generally do in all these assignments. Additional procedure may be like additional inquiry, additional analytical procedures. If we do find out of analytical procedure or inquiry that this is the particular area, we find an area, suppose sales, we find that this area needs a greater concern, greater interest of our time. So we need to, if we feel that we need to perform more detailed test for that particular area, then obviously we should go and perform that test. So these are some of the additional procedures that can be done, and these additional procedures are derived, or the adequacy of these additional procedures comes from the identification of any issues or identification of any such news or any such information that we gather during the performance of the engagement, that as a practitioner we feel that no, we need to carry out some other more additional procedure before we conclude on the engagement. Subsequent events, we are not required to, there is no obligation to perform any procedures after the date of audit report. From the close of the financial statement till the date of our audit report, we need to have a subsequent event review. We need to have a subsequent event testing to ensure that there are no such events occurred after the financial statement closure that requires an adjustment or a disclosure or any impact into their entire financial statements as per the reporting framework. So, but once the report is issued, we are not obligated to perform any further procedures from the date. We need to obtain written representations from the management, as we do in other engagements also, in our auditing or in our review engagements. We need to obtain representations from the management. The representation should clearly state that its management has fulfilled their responsibility for preparation of the financial statement as per the financial reporting framework, and management has given us all the due information that are required for an engagement, and we have been provided with all the access of the books and all the information and access to peoples. So these are something which management has to specifically mention in their written representations. If management refuses to mention something into that written representation, then we need to again reevaluate the integrity of the management, that what is the reason management is refusing to mention it into the management representation or in the written representation. And we need to take this matter to the management or to the TCWG wherever required, and accordingly see or accordingly take an action on our reporting part. Like if we are not able to obtain written representations, how will we give a conclusion for that? Evaluation of evidence is obtained. Out of all those procedures we have done, out of all those assignments, the engagement procedures that have been done during the course of engagement, the evidences are to be evaluated to ensure that yes, we do have now sufficient appropriate evidence that we can form, as a practitioner, we can form a conclusion under SRE 2400. If we are of the opinion as a practitioner that we do not have enough sufficient appropriate evidence, then we need to perform other audit procedures, additional procedures, to ensure that we have sufficient evidence before issuing the conclusion. If we are unable to obtain sufficient appropriate evidences, we need to discuss with the management and the TCWG the effects of the scope on the scope of review and the reporting considerations. This is the most important part of the entire SRE. After all those things like understanding of the objective, understanding of the quality control, understanding how to accept the engagement, agreeing the engagement, performing the engagement, evaluating the evidences, now comes the final part of the forming conclusion. How is a conclusion to be formed? So we can flow in the manner it is being displayed over here. If whether the historical financial statements adequately describe the applicable financial reporting framework, yes, whether yes or no. Terminology used in the historical financial statement is appropriate, yes or no. Whether the financial statements disclose appropriately the accounting policies, whether the accounting policies are consistent with the financial reporting framework and are appropriate, whether the financial statements appear relevant, reliable, and comparable in terms and understandable in terms of other peers' financials or as per the financial reporting framework, and the effect of material transaction and events are adequately disclosed in the financial statements. If any material transaction has been occurred or impacted during this particular financial year for which we are giving a review report, all those material transactions have been adequately impacted in the financial statements and adequately disclosed so that the readers of the financial statement are aware of all such transactions. If all those things are fine, we need to assess the impact of identified uncorrected and the qualitative aspects of the accounting practices, and finally conclude on the overall presentation and the structure of the content of the historical financial statement. So if we, after performing the entire procedures that were designed at the initial level, from understanding the entity to the materiality level, if we have sufficient appropriate evidence and are of the view that yes, we can conclude on the basis of sufficient appropriate evidence, and this the applicable financial reporting framework has been duly complied with, we need to form an opinion or we need to form a conclusion and issue a report. So that can be again of two parts, two ways, unmodified and modified. These are similar to in terms of our SS 700, 705, 706. These are similar to those standards, that whether we need to issue an unmodified report, which is basically a clean report, and we give a negative assurance that yes, nothing has come to our attention that make us to believe that the financial statements are not prepared in all material respects, as per the applicable financial reporting framework. Last, the modified approach, if from, or the modified result or conclusion, if from the evidences we obtained, we identify that we cannot opine or we cannot form an adequate conclusion, on the basis of report. We need to have that impact on the basis of, like we need to give a disclaimer of opinion, we need to give a qualified opinion, or we need to give an emphasis of matter. We need to evaluate in that part, and then we need to form an adequate report for this. That's all from SRE 2400 perspective. Thank you.